Welcome to this Fund Manager Q&A brought to you by Livewire Markets. My name is Vishal Tekshnani. Offices are going extinct. Shopping malls are going to become ghost towns. These are some of the theories being bandied about by investors in the post-COVID-19 world. But will it be true? Joining us for an all-important discussion today on the future of the A-REIT and property market is Pete Morrissey from APN Property Group. Pete, let's get straight into it and start off with retail. We've seen the perfect storm for the retail sector. Shopping malls like Vicinity and Centre Group, they've been hit by a plunge in footfall traffic, and they've also been hit by the rise in online shopping and how that's become so much more visible. What's your take on the future of shopping mall assets?
Well, the future of shopping assets, it's going to vary. We feel right now, clearly the large malls that Vicinity and Centre Group own have been severely impacted with their foot traffic numbers declining significantly with the lockdown that is being put in place. But obviously these malls will recover at some stage. But in the meantime, we've got more convenience-focused centres which are underpinned by supermarkets, which have been going gangbusters. Their performance has been really strong. And so a lot of people are going to those types of smaller centres, and the returns that, or the performance of the supermarkets, the chemists, those types of things have underpinned those landlords. And they're landlords like CQR, Charter Hall Retail and Shopping Centres Australia, which have strong exposures to Woolworths and Coles primarily. So there's a real deviation in the outcomes that we're seeing right now. But that's in the short term. Obviously, in the medium to long term, we will get a reversion back to normal patterns that we've seen in the past. Some of the smaller tenants obviously will face pressure and may not come out the other side of COVID-19. And landlords obviously right now, due to the leasing code of conduct, have a lot to deal with, and retail land primarily. But they will come out the other side with the significant support that the government has put in place.
Something you mentioned previously, Pete, has been that shoppers will return. We've seen it in MERS, we've seen it after SARS. What makes you so sure that as far as those discretionary shopping malls go, that it'll be different, it won't be different this time around? Because if we think about how established online shopping has become, Amazon is a mainstream name. And then you have apps like Afterpay sending you push notifications to buy something online. What makes you so confident that as far as the discretionary side of retail REITs go, that shoppers will come back?
Well, obviously certain categories have suffered from online more quickly than others. We can all recall around books, travel, those types of things have really been impacted by online. Whereas things like apparel, it's been a lot slower, but it is occurring. But what we're seeing from the really good landlords, and Australia is lucky enough to have some of the global leaders in this regard, is that they continue to reinvent the shopping centre. Over time, Westfield, the Chadstone of this world's Bondi Junction, those types of centres, if you visit them on a fairly regular basis, you'll see a regular turnover of tenants that occurs as they continue to represent those centres to meet consumer demands. And that's the key thing. These guys have done this for decades in some instances, and I feel that they'll continue to do so. As you can see, in more recent times, we've seen a lot more emergence of food and beverage, entertainment, as the centres become more destinational. So I think there will be a recovery in a lot of the good landlords and the centres that they have. But they'll have to have a really good look at what they've got on offer now, where rents are, and then try and ensure that they're in the right place to meet what the consumers want going forward.
Okay, and so if we focus on that point, what you mentioned is effectively, there'll be a cycling through of tenants, the ones that are more relevant to shopping and consumer behaviors today. Do you see a change in the profile for things like how tenancy agreements are structured, what type of rents these shopping malls can obtain? Because investors have been used to, very juicy yields of 4, 5, 6, 7% on some of these. Will that change at all?
There will be some change, I think, with rents, but that has been occurring over some time. We've seen negative rent reversions occurring for centre group and vicinity for a number of years, as factors such as the weaker consumer sentiment, low wages growth. A year or so back, we had a couple of years of weaker residential housing performance, and we'll probably see that again. So that is all a headwind for retail, but also there's this ability to continue to reinvent these centres for good landlords. Rents will be harder to get, but there's new opportunities as well for many of these guys. And also, the real recognition by good retailers themselves that you need both an online model and a bricks and mortar model to be very successful in most categories of retail that are out there today.
Okay. Pete, if we move the conversation to the office space, investors have again been used to rivers of gold from the likes of Dexus and GPT, but now an increasing number of business owners are saying, this virtual work from home thing is actually pretty good. Why do I need all this office space? And you've had signs of this take place already. Optus, for example, has announced that its call center staff can work permanently from home. And you're seeing these conversations take place in the business community about, just how much office space do we need, if we need an office at all. What do you think the future looks like for office properties?
In the office space, there's no doubt that there will be opportunities for some businesses to move more of their staff to work from home. That's a trend maybe that it had been occurring to some degree, but really there'll be a recognition that this really can work for some businesses, and probably more the small to medium size. I just feel that many large businesses or businesses in general out there will currently be missing the benefits of the collaboration, the benefits of working together, bringing staff together, that office space brings, the attraction that has for many staff to be working in space that has end-of-trip facilities is a really, really great place to work. Will be missed by many businesses right now. And I feel there'll be a range of views around this. Some tenants and some of us ourselves will be quite happy to spend more time working from home, but many others, I'm sure, won't ever want to work from home again. And perhaps have seen this as a real barrier to getting business done in the way that they normally do. They're not able to do so in the current environment, and will be quite happy to revert back. So there'll be a mixture of outcomes, I feel. But in general, I feel the office space is really important. The landlords in office for many years were quite bland, I suppose, in what they provided their tenants. But in the last 5 to 10 years, there's been a really significant improvement, is that recognition that you've got to have good space to get really good outcomes, good collaboration, good ideas to get your business performing to its maximum.
Okay, so when we think about your what you said about shopping malls, there will be a response from shopping malls. They'll find tenants that are more relevant to consumers today. Do you expect a response from offices in terms of how those buildings are configured to attract business owners and people into offices?
Sure. Well, probably, I think right now, the move that we've seen in the past 2 or 3 years to flexible space, the benefits that brings many small businesses. Potentially, right now, that tap is turned off for an office landlord from rent because those people aren't there. They're on a very short-term lease with the provider of that space within the building. But I think a lot of those people will come back. The benefits that space brings with flexibility for a small business owner to be in amongst where their clients are, to have a really strong face to their business will be increasingly important. And, the other side of how things go post-COVID-19, there may be emergence of a huge amount of opportunities for new businesses. No doubt some businesses will struggle, but there will be a lot of businesses that will come through to replace them and occupy the space, I feel, going forward.
So Pete, if we think about the changes taking place in retail assets, in office REITs, how do investors play this environment?
The sell-off that occurred was extremely aggressive for A-REITs, and so that has presented a real opportunity for investors focused on the medium to long term. There will be impacts on the earnings that come through for a large number of the REITs in FY20 for sure, with guidance removed by many names, and into FY21. But there'll also be a stabilisation from that period and then a sustainable recovery as we emerge from the other side of COVID-19. And I think that's a real opportunity for investors that can see through this. Those are the drivers, I feel, that has seen the sector recover 25% from its lows as that aggressive, indiscriminate selling that occurred, panic selling, was seen to be overdone and is now beginning to unwind. There is a lot of water to go under the bridge, without doubt, but the real estate sector is perhaps at the forefront of this and may see the sunlight of the other side of COVID-19 and its implications sooner than many other businesses, in the same way that it perhaps saw the impact sooner as well.
Okay. On your analysis, what are you expecting for yields throughout this period? We still have reporting season to come. Many businesses are yet to feel the full brunt of it all and announce their results. What are you expecting for the REIT sector from an income perspective, and also, long term, what type of yields can investors expect?
Well, based on our numbers, and it is very difficult to know without the leasing code of conduct. The negotiations are only just beginning, so really we're not going to know the outcomes until the REITs provide clarity on what their distributions are for the second half, and then hopefully some guidance for FY21 in August. So there is a lot of water to go under the bridge. Realistically though, some of the REITs are going to be quite significantly impacted. As I said, those more names like Vicinity and Centre, and that's been really reflected in their prices. But going forward, there will be a stabilisation period through the next year to 18 months, I feel, for the sector. And then from that, there'll be a period we'll be able to grow, hopefully in a sustainable, steady manner, the majority of that return coming from that income going forward. So it's really difficult right now, but the key, I think, for many investors will be the fact that the spread that REITs provide, the yield that they provide compared to other asset classes, cash, fixed income, those types of things, term deposits, will be very attractive. That will continue, and that'll be a key benefit for many investors seeking to invest into the sector now or in the coming months, I suppose, because the uncertainty is the opportunity for many investors as well. Okay.
Can you talk through how you're positioning yourself in the APN property fund? I notice you've got nearly 70% of your portfolio still in retail and office assets, and unlike some other managers, you're still fairly underweight on industrial properties. Would that be fair to say?
Sure. Look, we are underweight industrial, but our mandate inhibits us investing into active businesses such as Goodman, as an example, which is really the industrial exposure in Australia. Goodman only collects 30% of its earnings are rent, and its payout ratio is around 50%. Hence, the yield is 2.3% as we sit here today. So that's a very, very low yield for us. Those active earnings, perhaps we see as an income-focused investor. We want to be focused towards names that are going to provide more yield for us going forward. And so that gives us a skew. But within our retail, where the composition for us is really important. And as I said to you earlier, the non-discretionary and discretionary retail are quite different things in the current environment. So the non-discretionary is the convenience, the neighbourhood centres. We've got a really strong bias, and our big overweight positions are in those names. We're underweight Centre Group and Vicinity because we feel there is less certainty in their earnings in the shorter term. On the office side, we've got stronger weights towards the smaller cap names that perhaps have higher components of government tenants, as an example, who we feel are going to come through this and continue to pay their rent in a very strong manner. So it's worthwhile understanding the underlying retail exposure. Also within that, for us, is what we, more convenience around service stations, as an example. Clearly, those guys are continuing to pay their rent, operate, not impacted by the shutdown. So we feel there's some really good value, long-term sustainable income coming through with regular growth on an annual basis. So, looking through, whilst we do have retail, the components and the structure of our retail exposure has changed considerably in recent months.
To be sure, Pete, can you give me 2 or 3 of your favourite REIT names?
Well, one of the best I feel for us is Centuria Industrial, because it is a specialist industrial name. We really like that opportunity that provides, good, consistent management track record. They're working those assets hard, and we feel for right now that the capital values in industrial will hold up pretty well. And 2 others, Viva Energy, REIT, which is going to be renamed in the near future. That's a good name because effectively it's petrol stations. Obviously, they've become more convenience retail focused over the more recent years. And while petrol volumes are down, that doesn't matter. They're still paying the rent, and that's what we like to see.
Okay, Pete, great talking to you. Is there anything else you wanted to add?
Oh, look, I just feel, it is a great opportunity for investors looking for the medium to long term. Our sector, without doubt, has really felt it through March, the immediate impact of COVID-19 and what is coming with it. But I feel that we will come through this perhaps quicker than other components of the broader equities market, where they're more reliant on growth, and the outcomes and the implications for those businesses are yet to be worked through. And so the relativity of the value on offer right now, I feel, and the outcomes that we will get through this will come out the other side. And, like we did in the GFC at the darkest, it was a great opportunity for many investors. And, property at the end of the day is very integral to the running of the Australian economy and businesses within our country.
Pete, thank you so much for your time.